1. The shock when the market crashed. Early Monday morning in Austin, Texas, 35-year-old amateur investor Ethan awoke to a notification on his phone. S&P 500 dropped 7% in the last trading session. He scrambled to his laptop and watched in horror as his portfolio plunged $30,000 in just 72 hours. Tech stocks were down 15%, crypto had tanked, and even his ETFs were bleeding red. Panic set in. He'd always told himself, just hold long term and it'll be fine. But now he wondered if that strategy alone was enough to survive every market tremor. Part 2. The discovery. What is margin of safety? Desperate for answers, Ethan met his one trusted money mentor, Uncle Sam, a retired financial analyst from Chicago, at a quiet coffee shop. How can I invest without freaking out every time the market freaks out? Ethan asked. With a knowing smile, Uncle Sam replied, you need a margin of safety. He explained that it's the gap between an asset's intrinsic value and the price you pay. Buy a $300,000 house for $200,000 and you've got a 33% margin. Buy a $100 valued stock at $70 and you've got 30%. The bigger your margin, the better you sleep, he said, quoting Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Part 3, the mistakes! Ethan's past failures. Flipping through his investment journal, Ethan confronted his past errors. Buying on emotion driven by Reddit and TikTok hype, investing without understanding the businesses, lacking any exit plan and panic selling at the bottom, ignoring key metrics like PE, ROIC or DCF in favor of momentum, and going all in with no emergency fund, forcing him to liquidate at rock bottom prices to cover living expenses. Part 4, the rebuild. Learning to invest with margin of safety. Determined to change, Ethan devoured The Intelligent Investor and Seth Klarman's Margin of Safety and studied value investors like Monish Pabrai and Guy Spear. He began performing fundamental analysis, examining profits, cash flow, debt and competitive advantages, and built DCF models to estimate true values. He set strict buy criteria, only stocks trading 30 to 50% below intrinsic value, favouring businesses with durable moats. He sold unclear value positions focused on stable, dividend-paying companies, maintained a 6-month emergency fund, avoided margin loans, and practiced emotional discipline by maintaining an investment journal and resisting daily portfolio checks. Part 5. The wisdom, margin of safety beyond investing. A year later, Ethan's portfolio hadn't doubled overnight, but it was growing steadily and safely. He no longer panicked when market in turmoil splashed across CNBC. He realized that margin of safety applies to life too. He carried proper insurance, saved before spending, and never left a job without a backup plan. Margin of safety isn't just an investment term, it's a life philosophy, he reflected. Part 6. The gift. Passing on the knowledge. Ethan launched a blog to share his value investing journey, writing weekly posts and connecting with the FIRE community. One afternoon, his 10-year-old son Liam asked, "Dad, what's a stock?" Ethan smiled and answered, "It's a tiny piece of a company, and if you buy it at the right price, your money works for you." Part 7. The core. What will you do? Markets will always be volatile, but fear is optional. Learn to find intrinsic value, invest with a margin of safety, and build buffers in your life. If this story resonated, hit like, share with someone who needs it, and subscribe. Remember, margin of safety equals freedom to sleep well.